Welcome back to the channel, everyone. Today I want to talk about what the Fed is planning to blame the current market crash on. I also want to talk about how these large hedge funds and other institutions are likely to receive bailouts and escape once again with their criminal activities. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, we know the market is currently crashing. As of Friday, the S&P 500 officially entered that bear market territory, down over 20%. The Nasdaq has also been in bear market territory for some time, and again as of Friday was officially down over 30%. Similarly, in housing, crypto and the bond market, we know that crypto is down over 50% from its highs, housing is starting to crack, and bonds are currently all over the place. Now, I'm sure that by now, you the viewers know that this isn't just some freak accident caused by the pandemic. Instead, it's as a result of these hedge funds and institutions being wildly over-leveraged and pumping the market over the last few years. Back in 2008, all they received was a slap on the wrist, some small fines, a giant bailout, and they were told to reduce their leverage on the housing market. So what did they do? These hedge funds and other institutions looked to other markets, aka the stock market, in which they could wildly over-leverage. Many of these institutions are ridiculously over-leveraged, with rates even higher than 130 times to 1, using derivative products such as call and put options, swaps, and many more. We know the reason the market is currently crashing is a result of these large institutions being wildly over-leveraged on the stock market and pushing the market up higher and higher and higher over the last few years. But now as inflation has spun out of control and the interest rates are being pushed up, the stock market is starting to fall and these wildly over-leveraged hedge funds are caught with their tail between their legs. It's too late for these hedge funds to begin their deleveraging process because they're already too heavily leveraged, they're already sitting on significant unrealized losses, and they're approaching closer and closer to that liquidation and margin call point. As you'll see in a little while, Kevin O'Leary believes we need some major players to be liquidated and end up going bankrupt to cause the market to bottom out. But as I'm sure you've realised by now, when some of these giant institutions end up going bankrupt and billions, if not trillions of dollars are lost in the process, these hedge funds and institutions aren't likely to receive any of the blame. Instead, they're more than likely to receive bigger bailouts. Instead, the Fed will find something to pin the blame on and say, guys, these hedge funds and institutions didn't crash the market. This is what crashed the market instead. And I think I've just found exactly what the Fed is planning to pin the blame on. Charles Payne tweeted saying, obviously the market is already vulnerable, but this leg down was sparked by this headline. He tweeted saying the World Health Organization is set to hold an emergency committee meeting on potentially the new pandemic outbreak on Friday. Charles Payne said the last thing anyone wants to hear is the WHO or World Health Organization and outbreak in the same sentence. He followed that up by saying, I interviewed two brilliant medical or science guys that I know, and they assured me that this potential pandemic is not a big deal. He said it's been around for decades, and he's not convinced. He asks, why is it popping up all over the world right now? Why is the WHO chiming in? And what is really going on? And Peter Sweden followed up by saying, just in. Belgium requires anyone with the new potential pandemic symptoms to quarantine for 21 days. Here we go again. Now I'm going to tell you what I am and what I'm not. I'm a random guy that makes videos and puts them on the internet. I have a background in accountancy and I've worked for some high-level firms during my time. But what I'm not is I'm not a politician, I'm not a medical expert, and I'm not a doctor or anything like that. I'm not here to debate whether this potential pandemic could turn into a new pandemic. I'm not here to debate how dangerous it is or how dangerous it isn't, or anything of that nature. But what I am saying is that it's an awfully convenient time to release information on a new potential pandemic, just as the market is setting a new leg down and setting new recent lows. It wouldn't surprise me if the Fed is looking for an excuse to blame the current market crash on at a time when supposedly the economy is strong. This is obviously a photo of Jerome Powell pushed on a backdrop of the S&P 500, showing all of the stocks in the S&P 500 and their current losses to date this year. And guys, be sure to sign up to Moomoo using the link in the description below to get up to $17,500 in free stocks. Moomoo and Futu have also officially announced that they do not accept payment for order flow, and therefore Moomoo is brilliant for buying that AMC stock. Moomoo is also voted the best trading platform because it's very easy to use and it's incredibly customizable. We've got stocks like Microsoft down 24%, nearly 25% this year, Apple down 22%, Nvidia down over 40%, Google down 23%, Amazon down 35%, and much, much more. Now, obviously, you can see, looking at this chart of the S&P 500, the only sector that is green so far this year is the pharmaceutical industry. I wonder why. But obviously most other stocks, especially tech stocks, semiconductors and internet content stocks, are down significantly from their recent highs back in December. And Deutsche Bank has said that the S&P 500 could plunge to 3,000 points or below if the economy falls into a recession in the near future. Now, you may remember that I've shown you this chart of the S&P 500 many times over the last few weeks, and I haven't yet changed any of the lines on this chart. We can see the S&P 500 is tracking this downwards line perfectly and has now fallen below that $400 level quite convincingly. I also drew this line around the $350 region, saying the S&P 500 could fall below this region, and at that point I'd start buying back into stocks. But crazily enough, Deutsche Bank believe the S&P 500 could fall even further to this 3,000 point level or this $300 level just here, even further than I thought the market might fall. But considering that banks usually underestimate just how bad market crashes and market pullbacks can usually be, the S&P 500 may fall even further than that $300 region, maybe back down to the $250 region or the $200 region. I'm going to keep these lines on this chart and over the next few weeks and the next few months continue to see how the market crash is playing out and whether we continue to track this line down even further. And Kevin O'Leary believes we need to wait for some major players to end up going bankrupt for the market to fully bottom out. So let's hear what he has to say.
Three, at the end of the day, have we had the capitulation yet? And I say no. You know, having seen this movie before in the past, what I want is a big event. A big 3,000 point down day when a hedge fund blows up, or in this cycle, maybe a Bitcoin company goes to zero. Somebody's in trouble right now, somebody huge, over-levered probably, we don't know who they are. But if you look back at great bottoms, it's always on a day of absolute chaos because somebody goes to zero. I want that. I'd like to sacrifice somebody, not me, of course, but somebody, and I'm not levered, but somebody out there is, and they're going to zero, and that will be our bottom. But we're nowhere near that yet. This slow grind down is painful, and it will continue.
And I think Kevin O'Leary really hit the nail on the head there. We haven't yet seen the market bottom out, and what we need is a large player, like a large hedge fund that's currently very over-leveraged and currently in a lot of trouble, to go bankrupt and cause basically a final nuking of the market before it bottoms out. Now, I think secretly Kevin O'Leary knows there is a major hedge fund or a major player out there that is currently very over-leveraged, that is on the edge of bankruptcy. A, he probably can't say, and B, he probably doesn't want to say because he probably doesn't want a cabal of billionaires on his tail. Now, I imagine it's going to be one of those heavily over-leveraged hedge funds taking risky bets, aka like Citadel, who are known for using leverage rates of over 8-to-1 and obviously shorting AMC and GameStop. Maybe it's a different fund that's using equally as risky bets or is using swaps heavily like Bill Hwang. Maybe it's a fund that's even larger than Citadel. But all that Kevin Leary knows is that there is certainly hedge funds on the edge of bankruptcy about to go under. But also, as Nazim said, it's not just the stock market that's in a lot of trouble. Nazim tweeted saying housing foreclosures and credit default rates are rocketing to levels never seen before. He said this is just starting. And the US foreclosure activity sets post-pandemic highs in the first quarter of 2022. The US foreclosure market report shows a total of 78,000 US properties with a foreclosure filing during the first quarter of 2022, up 39% from the previous quarter and 132% from this time last year. And also, as Paolo tweeted, it's not just the stock market, it's not just the property market, but it's also the crypto market as well. Paolo tweeted saying Tether would likely to believe the USDT stablecoin that is purportedly backed by tens of billions of dollars of assets in reserves has only the best accountants and auditors in the world. Obviously, many of these large companies, these large hedge funds, these large institutions and banks only use the top of the top accountants and auditors, aka the Big Four. Now, these are the largest 4 firms in the accountancy sector that outweigh all other firms by a clear mile. Most hedge funds and institutions only use these Big Four auditors or Big Four accountants because of their reputation and their ability to handle larger workloads. They don't just have 10 employees in a small local office, they have thousands and thousands of employees all across the US. But actually the truth for Tether is that their accountant and auditor for an 11-figure company is just a PO box. They don't even have a proper office. Now the auditor for Tether is the Cayman Islands branch of MHA McIntyre Hudson. Now McIntyre Hudson does have some presence in the UK. It's currently the 12th biggest auditor, which is a fairly small company, especially as they're largely only based in the UK and in the Cayman Islands. Again, you would likely expect one of the Big Four, Deloitte, PwC, Ernst & Young or KPMG to be performing the audit of an 11-figure company. You almost certainly wouldn't be expecting a PO box in the Cayman Islands to be performing the audit of this giant company. I think this just goes to show that USDT is looking more and more sketchy as the time goes by, and it's likely that USDT could crash, potentially causing the entire crypto market to implode. So guys, be sure to leave a comment down below and to also ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.